Hello and welcome back to our series of free webinars concerning Level 1, CFA Level 1. I'm Daniel Lambert. I want to talk to you about financial reporting and analysis. We'll be dealing with the cash flow statement, the statements of cash flows, as well as the revaluation surplus. So I uploaded something for you, and that is those questions dealing with, first of all, the revaluation surplus, the possible revaluation surplus that we need to build up in the different periods. So we have the balance sheet, we have the statement of the income statement, as well as the cash flow statement. First of all, we need to take a closer look at the revaluation surplus. What is this? Like, consider this. A New York-based company purchases land of 100 square meters for 10,000 euros on January 2nd in the year 2016. Now, as time goes by, as time develops, the value will rise, the fair value are going to rise or going to go down. So what shall we do about it? Is there a way of putting our value up or down? That's the important question here. That's what we need to consider. So taking a look at the International Accounting Standards number 16, there is different things to do. And we will see here what happens. So the first thing to do is the carrying amount. So when taking a look at the balance sheet, there's the carrying amount. Does the carrying amount reflect the fair value or not? And as a matter of fact, yes, it does. If the fair value goes up, so will the carrying amount. If the fair value goes down, so will the carrying amount, leading to a revaluation surplus being part of other comprehensive income. So revaluation surplus is not a part of income statement, but it's a part of the balance sheet, directly of the balance sheet. There is no revenue combined with it. There's no expense combined with it. It's just revaluation surplus is not a part of the income statement. So let's consider this. We have the fair values of, say, 10,000. Let's just say 10,000 was the fair value at the beginning of the first year, 2016. Then it's 11,000 euros. Then it goes down again to 10,200. It goes further down to 9,700, then 9,900, and at the very end is going to be 10,500. So we need to understand what happens with the carrying amount. What's going to happen with the carrying amount? And that is this. First, the carrying amount is equal to 10,000 euros, of course. Now, at the end of this first year, 2016, the fair value rises to $11,000. And as the International Accounting Standards try to reflect the real value, as I may call it, the real value. I mean, there's no real thing in financial accounting. It's always a matter of measurement. And this measurement is done by human beings. So there is no real value, but only value created by men and women. So 11,000, what would you do with it? The thing is, we need to create a so-called revaluation surplus equal to 1,000. Carrying amount will be equal to 11,000. So there's one thing on the debit side and there is another thing on the credit side, which is property, plant, and equipment go up. Property, plant, and equipment will go up by 1,000 euros. And so will the revaluation surplus. The revaluation surplus is going to rise by 1,000 euros just as well. But it has no impact on the income statement. There is no impact whatsoever by revaluation surplus. There is there is no indication and no linkage to the income statement by the revaluation surplus. So there is the impact on the other operating income by 1,000. Now, things that went up without touching the income statement need to go down just as well without touching it. So as we go down again to 10,200, because that might be your CFA level 1 exam question, it goes up to 11,000, then goes down to 10,200, then further down to 9,700, and so on and so on. As you can see, the value went up and went down without touching the income statement. So what are we going to do? We're going to put it to 10,200. The revaluation has to go down as well, from 1,000 to 200, which means it sinks by 800. And that means, again, that revaluation surplus is going to be touched on the debit side. Revaluation surplus, of course, is part of the balance sheet, is part of the right-hand side of the balance sheet. And where do the right-hand side accounts on the balance sheet go down? They go down on the left-hand side. They go down on the debit side, right? So revaluation surplus is touched on the debit side by $800, 800 euros, I'm sorry. And property, plant, and equipment goes down as well by 800, but since it's an account on the left-hand side, accounts on the left-hand side of the balance sheet go down on the credit side. So this is what we need to do here. Is there any impact on the income statement? No, there is not. So that's that. And the other operating income goes down by 800. So we put it in brackets, meaning that it goes down, it shrinks by 800 euros. Now, it goes further down. It even touches the historical cost of 10,000, and it goes even further down to 9,700. So carrying amount, 9,700. And the revaluation surplus that we created 2 years ago, it was 1,000, then it was 200, now it's nothing at all. It is nothing any longer. The revaluation surplus is equal to 0. But this does not suffice. We need to have a further decline. We have to need a further decline in the value of property, plant, and equipment. So let's see. Revaluation surplus goes down by 200, because it was, as a matter of fact, 200 the year before. So does property, plant, and equipment. It goes down by 200, meaning other operating income, which was not part of the income statement, went down by 200 just as well. But this is not enough. This is not enough because we want to reflect the decline of the value of property, plant, and equipment by 500 euros, and we only reflected like 200. So what's about the remaining 300? The remaining 300 are considered to be an expense. Before it was not, but now it's an expense. And now we're deep inside the income statement, and that's very important. You really have to discern, you really have to see the difference between being part of the other operating income, not being part of the income statement, and then suddenly going back to the income statement. And that's part of the International Accounting Standards, Standard 16, paragraph 39 and paragraph 14. If you want to look this up, please go there and see that this is the way we're going to deal with it. So 300, another 300, where shall I put it? I will put it here. Our expense. And where do expenses rise? Expenses rise on the debit side, and they go down on the credit side. And revenues rise on the credit side. I'm sorry. Revenues rise on the credit side and go down on the debit side. So that's always important for you to see. Are we on the debit side or are we on the credit side? is the account going to go up or is it going to go down? That's important to see. Expenses rise by 300 euros and property, plant and equipment, I wanted to say property, plant and equipment are going to go down just a little bit, again by 300 euros. I mean, just a little bit. You see what I mean? Now, an account on the left-hand side of the balance sheet, which means, for example, property, plant, and equipment go down on the credit side. So we have to see that property, plant, and equipment by 300 euros go down and are part of the credit side. So what happens now? There's an income statement. There's an income statement effect, which means there is an expense, there is a shrinking. Net income goes down by 300 euros. So that's important. There is an effect on the income, on the net income, and there's another effect on other operating income, but they are very different from one another. Very different from one another. Net income is totally different to operating income, because the one thing, net income, is like it's part of the income statement and reflects revenues and expenses, whereas the other does not, whereas the other is directly a part of the balance sheet. Next period, although, oh yeah, we need the next period to be able to answer the question, because the question was using the revaluation model of IAS 16, the other comprehensive income in the year 2019 will be 500 or will be 0 or will be 200. That are the three answers that are given here. And one of them, exactly one of them is true, the others are not. Let's see. Let's see, 2019 is going to come now. 2019, we're still here. We still need to wage that war of question one, if I can call it this way, 9,900. So it goes up a little bit again. The property, plant and equipment went down to now 9,700. Now it goes up again to 9,900, meaning that there is no such thing as revaluation surplus, because only if it goes beyond 10,000, there's a revaluation surplus. Now, as we said in the period before, there's an effect on the income statement. We have to take back this effect on the income statement itself, meaning that there is a revenue, or that there's, I don't know, you have two possibilities, like have the expenses on the credit side, meaning they go down, or just have a gain, which is better on the credit side. So all in all, each thing you do, there is a positive effect on net income. Net income is going to rise by 200 euros, meaning this, gains. There is a gain, 200 euros, and property, plant and equipment is going to go up by 200 just as well. No revaluation surplus, and 200, but as an effect of the income statement, because if the income statement goes down and the effect is reversed, so the income statement is going to go up again, meaning there is no effect on other operating income. The effect, and that's the answer, the effect on other operating income is 0. Isn't that a nice answer? That's cute, isn't it? The effect on other operating income is 0 because it's totally absorbed by the income statement. The entire effect is absorbed by the income statement, so there is no effect whatsoever in the year 2019, and the answer is no. The answer is no, and that was it. That was it concerning this question number 1. Now, and I'm sure revaluation surplus is going to be part of your exam, of your next CFA level 1 exam. I'm pretty sure about it because it's important. It's always very important. So be aware you fully understand the meaning of revaluation surplus, and I hope I could be of a little help with this small question. Let's go to the second one. Let's go to the second one. XA XAG, German thing, which is the German thing here, based in Frankfurt, reports the following: revenues $7,000, $70,000, etc., etc. And we want to change a little bit to cash flow statement, to the statement of cash flows. There's three very important things when it comes to financial accounting. First, the balance sheet. Second, the income statement. And third, the statement of cash flows. Of course, there's the equity, statement of cash, of equity, but we want to take a look at those three things here in this free webinar. There's two things to understand. Let's see this here in, where did I have this? Because I prepared something for you, and that's my mind map. That is the mind map for CFA level 1 that you can get, of course, in my online shop, if I can say so. So now, that is cash flow statement. My online shop on www.lamberteducation.com if you're interested in the entire level 1, CFA level 1 mind map. It's about 120 pages, I think, 110 pages. But now, cash flow statement. First, there is operating activities, investing activities, and financing activities. There's differences, of course, between international financial reporting standards and the United States generally accepted accounting principles. But those are differences with regard to details. There is, however, a larger thing we need to see, and that is this: the statement of cash flow statement. Can I? Let me see if I can. Yes. So there's the cash flow statement. There's the cash flow statement. And there are two really important things. First, you can calculate the cash flow by a direct method. And then secondly, you can do it via an indirect method. Both are true, and I mean, I don't know which one is easier. It depends on the question, of course. It depends on the numbers given. So direct method computes the cash flow as the difference between cash inflows and cash outflows. There's the cash inflow, total cash inflow, like loans received, for example, or cash collected from customers. And there's cash outflow, like money being paid to everybody. Cash outflow, what did I want to say? Yes, here, cash outflow. Cash inflow minus cash outflow is equal to the cash flow. The cash flow computed directly. That's the direct method. And then, of course, there is an indirect method. As I put it here, the indirect method goes this way. It goes net income, first of all, net income, plus expenses that were no cash outflow. So plus expense, yet it was no cash outflow, no cash outflow, no money leaving the company, minus revenue, that was no cash inflow, plus cash inflow, that was no revenue. Now it's a bit confusing, but when we see it, we'll see that the answer truly is the same as with direct method and indirect method. So plus cash inflow, that has not been a revenue. No revenue, minus cash outflow, cash outflow. That was no expense. That is it. And the result is going to be the cash flow. The cash flow computed indirectly. And the cash flow computed indirectly is going to be exactly the same as the one computed directly. So please make sure those results stay the same, because if they are not the same, it was wrong and you did something wrong. I don't know what, but there has to be one mistake committed if the two results are not equal to one another. Now let's see. Let's see, and we try to answer question 2, right? Question 2. So there's a revenue, $70,000, but the thing is, no euros, dollars, who cares? And I mean, given an exchange rate of about 1, it's about the same. I mean, not exactly, but you know what I mean. Anyway, yes, we want to compute cash flow via the two different ways. Now, cash inflow, there is a cash inflow, but no $70,000 are going to come in as cash inflow, but only 30%. 30% are going to come in. So the direct method, if we try to compute cash flow directly, it's going to say this: cash flow equal to cash inflow, meaning 0.3 multiplied by 70,000 euros plus the loan taken. And I have to admit, there's one thing. If you could please make sure you change one thing. The loan taken out needs to be 20,000. Please change the loan taken out from 2,000 indicated here to 20,000. I've got one digit of 0 there. So I had the option of either changing the task or changing the numbers in the solutions, but you're gonna get afterwards just as well. And I decided it's easier to just change the task. So please make sure it's 20,000. 20,000, a loan of 20,000 euros is taken out. So it's a cash inflow. It leads to cash inflow. 20,000, so there's a plus sign, and that is the cash inflow. Minus the cash outflow of, what did we have so far? There's a different loan paid back, 8,000, that's of course a cash outflow. Provisions is not at all a cash flow. It's neither cash inflow nor cash outflow. Property, plant, and equipment, cost of 1 million, fair value of 1,200,000 is neither cash flow, neither. So yeah, but the salaries paid are, and so are the interest expense. But depreciation and amortization are not part of cash outflow. Which means, as I wanted to say, it is 10,000 plus 6,000 plus 8,000 euros, isn't it? Which means 21,000 plus 20,000 is equal to 41,000, and this gives 17,000 euros. 17,000 euros is the actual cash flow. I mean, computed the direct way. Maybe it's different the indirect way, but then we would just have committed one fault. I don't know where. I mean, I wouldn't know where at first glance. We would have to search it then. So now, using the direct method, it is clearly 17,000. Now we need to use the indirect one, indirect method. I need to erase this. The indirect method. Indirect method. In order to prepare you for your CFA Level 1 exam, we're gonna do another webinar. One webinar of 5 days in November, held in English, and another webinar held in German, also taking place 5 entire days. I mean, entire day lasts 6 days, 6 hours. So like, I don't know the exact hours, but look it up on lamberteducation.com. There's the answer to this. If you might be interested in another type of preparation in November for your CFA level 1 exam in December. Yes, the direct method is this. The indirect method, if I may just use those colors, goes this way. The indirect method goes this way. And first of all, I need to just make sure that's webinar cash flow statement, large desktop. Here is this. Cool. First, we need to calculate net income, and that is the difference of revenues and gains on the one hand, and on the other hand, expenses. So, which means 70,000 euros is the one and only one revenue that we have. We only have this, or I mean the sum of revenues, as we might also call them. That's the revenue. So now the expenses are depreciation and amortization is an expense, interest expense is an expense, salaries paid are expenses. So they are expenses, the 6,000 and the 10,000 are expenses, and on the other hand, they're cash outflows. So they are cash outflows, and of course they are expenses. Whereas with depreciation, and amortization, this is not true. This is only expense, but no cash outflow. So all the three of them are expenses. So as we can see, let's just write them down. 70,000, 20,000, 20,000 plus 10,000 plus the rising of provisions equal to 2,000 euros. That's the rising of provisions. And how do you, what do we do with the provisions? Provisions rise on the credit side. So it's expense on the debit side and provisions on the credit side, meaning that provisions are going to rise and expenses are going to rise as well in order to create those provisions. Therefore, they are expenses, I'm sorry. Plus 6,000 euros. That was net income. Then it's a revenue that has not been a cash outflow. What's a revenue that has not been a cash outflow? It is, on the one hand, the rising of provisions, 7,000 minus 2,000. The rising of provisions, 7,000 minus 5,000, I'm sorry. Yes. So the provisions rise by 2,000, from 5,000 to 7,000. The rising of provisions, first. And second, there's 20,000, and I think that was the depreciation and amortization, right? 20,000 euros just as well, that were subtracted in order to calculate net income, which was correct, because the result of income statement is net income. So as we try to calculate the result of net income, it's of the income statement, we of course have to subtract 20,000. But since it was no cash outflow, we have to add it again in order to create, or in order to really compute cash flow, which means 20,000. 20,000. Here again, we add it back. That was that. That was plus revenue, but no cash outflow. Plus expense that haven't been cash outflow, minus revenue that have not been cash inflow, which means, oh yes, we had like revenues of $70,000, but only 30,000 really came in at the same time, in the same period. 70% of 70,000, which means 49,000 euros have not come in, which means 49,000 euros, $49,000 have been revenues, but no cash inflow. So 0.7 times 70,000 is revenue, but no cash inflow. Plus, now we want to add cash inflows that have not been revenue, and we want to subtract cash outflows that have not been expenses, as we can see here. So the only thing I'm doing right now is this. That's the only thing I'm doing, just to keep you back on track if you might have lost track. Plus, what's next? 20,000, that's the loan. That's the loan we've taken out. So we've taken out 20,000 euros by our bank. Our bank was so grateful, was just was very kind to us and gave us the opportunity to have 20,000 euros. But we paid 8,000. What was that again? 8,000 euros were paid back on a different loan. So we're talking about two different loans here. Don't mix them up. And as we see, as you may now type in your handheld computer, please do that. As you may now type in your handheld computer, this equals, and that's the fascinating thing about it, this equals exactly 17,000 euros. Isn't that great? Isn't that just great? Because the results are the same. It's not important whether you computed cash flow via the direct method or the indirect method, the results are the same. And that's great. And that's really great. I think you think the same, don't you? Now, that was question number 2, 17,000, which means 17,000, which means answer A is correct and the rest is not. Question number 3. There's also, as I might say, in our online shop you can have the mind maps. There's a mind map for CFA level 1. There's also mock exam questions if you want to prepare with more questions for your CFA exam. There's mock exam questions on lamberteducation.com for level 1. There's going to be some more for level 2 in the next months to come. What was I going to say? Oh yeah, question 3. A shoe manufacturer reported wages expense of $30 million. You paid wages that are expenses, and at the same time, that's cash outflow. At the beginning of the year, wages payable were $4 million. So there were 4 million euros to pay as wages, and at the end, there was only 1 million euros left. So what had happened? What's your answer? What would you say? What has happened? If wages payable were $4 million at the beginning of the year, and then at the end of the fiscal year of the balance year, it was only 1, which means we actually paid out 3 million euros, resulting, and that's the question, the amount of money this company paid in wages was closest to 33, 22, 27, and the answer, of course, if it had wages expense of 30 million, and on top of that, it paid out 3 million euros this year, it is 3 million plus 30 million, or but the other way around. 30 million plus 3 million equal to 33 million euros, which is number C. Answer C is correct, and the rest is not. So that was question 3. Great, right? Just a small answer to a long question, as should be the case in your CFA exam. Just take a glance and batch 10 seconds to answer the question. Talking about question 4. Another shoe manufacturer, or the same shoe manufacturer, is going to receive money from customers for products to be delivered in the future. So how are we going to report it? This webinar, as you might have noticed, deals with financial reporting and analysis. So it's really important that you understand this. There's two types. There's two main elements to financial accounting, and that is the balance sheet. That is the balance sheet on the first side, or first of all, the balance sheet, and second, the income statement. There's the income statement. And what's really important, the balance sheet is made up of a left-hand side, and a right-hand side, and so is the income statement. And on the left-hand side, you can see expenses, whereas on the right-hand side, there's revenue and gains. Revenue and gains. So on the left-hand side, if we consider it to be a T account, there's things rising on the debit side, the credit side, the debit side, the credit side, and that's truly important. Keep this in mind. And if you don't fully understand it at first glance, then just go back to this. Just go back, when you watch this video, just go back to the moment that I started to explain. So now the left-hand side of the balance sheet always rises, or the things are going to rise on the debit side. They're going to go down on the credit side. Whereas totally different, totally the other way around is true with the right-hand side. They're going to go up on the credit side, and they're going to go down on the debit side, right? The expenses are going to rise here, are going to go down there, and revenues, again, the other way around, rise on the credit side and are going to go down on the debit side. So that's always important to fully understand. If you don't fully understand this, you will always be confused. That's truly an awful thing with financial accounting, because if you don't understand this very detail with financial accounting, it's always true to understand anything, because it's always and truly based on this simple principle, because it's not really like it is easy. I would say it is easy. Once you understand it, once you fully understand it, it is easy. It's not difficult any longer. Now, what was I going to say? Talking about question number 4, we want to take a look at a shoe manufacturer. We want to review a shoe manufacturer that's going to receive money. He or she is going to receive money from customers for products to be delivered in the future. What are we going to do about it? At first, if he or she receives money from customers, what is money? What is money? Where would you see money located on the balance sheet? Of course, it is located on the left-hand side. So the inflow of cash is reflected by this debit side, credit side. The inflow of cash is reflected by cash put here, because you need to put cash on the debit side because it goes up. Your cash, the cash collected from customer goes up, so cash is going to rise, which means since cash is part of the left-hand side of the balance sheet, it's a thing that needs to be put here on the debit side. Totally different from the rest. We need something that's part of the credit side now. And it's a revenue. It is, well, I mean, is it really? No, I'm sorry. Sorry again. Sorry. What could we? It could be revenue. It could be revenue, but it is not. It is not. It's a part of liability. It is a liability, unearned income. Unearned income. And let me do one thing. We have the balance sheet and we have the income statement. And that's always true with all my webinars, income statement. In order to truly discern them, in order to truly see that there is a difference, I want to put everything that's connected with the income statement. I'm going to put it and underline it with green. And now I want to have the yellow. Where's my color? The balance sheet is going to be underlined with yellow. That means cash, of course, is a balance sheet thing. It's not a part of the income statement. It's part of the balance sheet. And so is unearned income, because unearned income is a certain liability. It's a liability because you get your money too early. Because you get your money too early, that's why it's called a liability. And now the next period, to be delivered in the future, in the next period, which is not a part of this task, but we want to answer it nevertheless, because you don't only have to know everything for your exam, you have to know for your life. You want to understand, you truly want to fully understand it. So next period, what's going to happen? Next period, things are going to change. So as we report revenue, this is going to change to revenue. Which is a green thing. Revenue is an income statement thing, and so is underlined in this green with green color. But we have to fully dissolve unearned income. We have to fully dissolve this unearned income. Which of course was a yellow thing. It was part of the balance sheet. So unearned income is going to rise in the first year. And now when things are delivered, when things are done by us, when the good is delivered, when the service is delivered, either one of them, the unearned income is to be erased, needs to be erased. So it's going to be put on the debit side to erase it because it's part of the right-hand side of the balance sheet, and it's going to be erased on the debit side, as you can see here, right? So always try to understand and then be aware that you fully understand this, because if you don't fully understand it, you'll always be confused. And yes, so now let's try to answer the question. The question is, what are we going to do at first sight, first glance? Report a revenue and a liability, but a liability would mean if a liability was created, it would be created on the credit side, and the revenue would be created on the debit side, which would mean that revenue would go down. So revenue, right, couldn't be created. They both should be created on, and they need to be created on the debit side. So it couldn't be possible. So A in itself is truly illogical. It's truly nonsense. Answer A is nonsense. And so is answer C, because as we report a revenue, reporting revenue needs to be done on the credit side, and reporting an asset needs to be done on the debit side. So reporting an asset there would be totally nonsense just as well. There is no asset. There is no asset. So answer B should look a bit different, should look a bit better. We create an asset and a liability, and look here, what did we do? That is an asset. Cash, of course, is an asset. You can look up the meaning of an asset in Framework 49. Framework 49, I think, point A indicates the assets and point B, the liabilities. So that's an asset, cash is an asset, and unearned income is, of course, a liability. Liability, and that's it. And that's it. So the answer B is correct, as we can see here. And we not only gave the answer for the first period, but for the second just as well, in order for you to fully understand everything you need to know. Not only the answer given here, but also the rest that's important. And that was it. That was it. We'll be dealing with equity at the end of this week, because that's a series of free webinars. I want you to tell that we're going to have a non-free webinar in November, one 5 days in a row in English, and another one, a different one, 5 days in a row in German. And for you to prepare you for your CFA Level 1 exam on December 1st, 2018. And if you watch this video, of course, there's going to be other webinars for the other dates in the future, 2019, 2020, and so on, for chartered financial analysts. There's also on my web shop, on my online shop, on lamberteducation.com, you can purchase, if you want to, the entire mock exams, level 1, also the entire mind maps, level 1, level 2 CFA. And yes, that was it. If you liked it, no, what should I say? Yes, if you liked this video, if you liked this webinar, please tell everybody else. If you did not like it, tell only me. Right, that was it. Thanks for watching. Thanks for listening. I'm Daniel Lambert, Berlin.